Hi, my name is Kelly Ross, and I am your host at Take 5 Tax Tips with Kelly. In this video, we're going to be talking about rental properties and all the ins and outs of what you can deduct each year and what to expect when you go to sell your property or when you're changing the use that you're going to have for it. So first and foremost, let's talk about how you need to report this. So the income that you're going to be receiving for rent each year would be your income that you're going to report on your schedule, on your personal tax return. It's not a separate tax return, it's a schedule within. Then you're going to be deducting expenses related to this property. So think about the things that you need to spend on this property on a regular basis. Property taxes, if it's a condo, there might be some condo fees in there. Do you have anybody helping you out with respect to renting out the property or maintaining the property on a regular basis? Those would be deductions. Are you paying for the utilities or is your tenant paying for the utilities? If it's you would deduct those. And make sure it would be all the various aspects of them, including your heat, electricity. What about insurance? You as the person who owns the property needs to have insurance, and the tenant should also have insurance as well, but whatever you are paying would become a deduction for you too. One of the expenses you want to be very cautious about taking is auto and travel. And the reason for this is it's very hard to justify all of your travel back and forth to the property in order to do various items. And the percentage that you'd probably have in comparison to the other activity on this vehicle is probably very, very minute and very small and might not really be worth your time to track. Now, if you're taking Ubers or taxis, it's very easy to have just an easy receipt per back and forth because you've gone to do any maintenance or repairs on these properties. That might make sense. Or if you wanted to go and just take a deduction for the kilometers because you are tracking them anyway, you can do that too. But just be careful because this is one of the areas that we do see CRA audit a lot and have been disallowing a lot of expenses on. Now, what happens if you've had to buy any appliances for the rental property itself, like a refrigerator, a stove, anything along those lines, or maybe you have to put a new roof on the property? These are things you can take a deduction for, but over a multitude of years. Not all in one year. So if you've spent $10,000 to $20,000 in a year, maybe even $50,000 doing a renovation, this isn't something that you can expect to have a full deduction on in that year. Depending on what it is in particular, CCA, which is called Capital Cost Allowance, there's a class that CRA will allocate to each different type, and that is what is going to have a different percentage for the amount that you can deduct in a year. Now, what happens when you go to sell the property? Well, if you go to sell the property, this is no longer your principal residence because you have been renting it out. Now, as a person who owns a home, and if you have only one property, you have what's called a principal residency exemption, and you're not going to pay any tax on any increase in value on that property. A rental property is a different story. With this rental property, it will have capital gains when you go to sell the property. So if it has increased in value, that is something you need to account for. And a very quick and dirty estimate on this right now is about 25% of the value of the increase that you have received is what you need to be putting aside. It could be a bit more, it could be a bit less, depending on other expenses that are going to come into play here when the actual calculations are done. But just know at the onset, about 25% of the value of the increase in the property is what you're going to be paying. Now, there are times where you might pay more, and where this will come into account is if you have been struggling to be able to pay your rental property bills every year at tax time when it comes to how much money you're making, you might have been depreciating the property that you purchased it for. And if you were, what that would mean is your cost base, meaning what you purchased the property for, the value has decreased as far as the amount that you can use to reduce that income that you have coming in. And you're going to have to repay any of that depreciation that you have been taking a deduction for in each one of those years. So your tax bill could be higher. So that's just something to caution you on. And it's usually something I don't recommend to people to do, to take the depreciation on those rental properties unless you absolutely have to in any specific year. Now, one other thing that comes up a lot with rental properties is there's something called change in use elections that you need to do on properties. So for example, if it's a home that you have and you've decided to rent out a portion of your home, and then let's say you no longer live in that home, you've rented it out, now you want to go back in because that tenant is leaving and you don't want to rent it out anymore. Well, now there's been a lot of change of hands of what's been happening in this property, and there's something called a change of use election that you need to be filing in each one of those years. Change of use election means it's no longer a principal residency, it's no longer a rental property, and vice versa, they're going back and forth. And with that comes the tax impact that comes along with that, unless you're filing a special election to defer any of those gains. So that is something that is available to you, and if you find yourself in that situation and need to talk more about it, feel free to reach out to our office and we're happy to discuss it with you. Thank you for joining me today at Take 5 Tax Tips with Kelly. Don't forget to subscribe to our channel for more information as it becomes available.